Hi, Jill. Hi, Jill.
Hello.
Hi, Jill.
Oh no, this is Cassandra. I'm just having trouble. Can you hear me?
Hi, Cassandra. I can hear you.
Okay, great. Hi, Burgess. How are you?
Good. Jill, are you there? Jill? Jill. Cassandra?
Yes, Burgess.
Have you had any meetings where they couldn't get your audio? That everything
I
you
have.
could, you were in the meeting, you could see everything, but they couldn't get your audio. Have you ever had that happen to you?
I have not because I call in.
Okay, that's smart. This happened to me yesterday, last week, with the same administrator, the same invitation, 3 different meetings had the same audio issue. It's weird.
That is unusual, yes. Yeah, I just call in. I find it just to be easier and clearer, and I can mute it. I don't know. Just stick
Yeah.
to what you know, I guess.
Right, and you don't have to put on your nice, your suit. You can wear your T-shirt you painted the bathroom in the day before.
You can, however.
Is it Jill? Hey, Jill? Jill? Jill Kaiser?
Hello. Okay, I'm good, thank you.
Unmute. Okay, my phone, you should be able to hear me now.
Hey, Jill?
Yes,
It's Burgess. How are you?
fine, thank you.
Do you have my report available that you can
Yes,
bring up later on?
yes, I do. I made sure I had it.
Well, thank you. Hey, Greg,
Yes, sir.
you got that gumbo made for me yet?
I will, we need to time it. I got everything I need.
Well, anyway, when you bring some over to the Palatka, give some to Dwayne too. I think he'd appreciate it.
Thank
Gonna
you.
do a 5-gallon cauldron and just bring it to the meeting and everybody can have a couple quarts.
Just bring a gallon, just make sure it's frozen so it'll, I can put it in the back of the car.
You say that like I have room in my freezer. I've been hoarding.
I don't know if your freezer's big enough for a 5-gallon bucket. That's why.
I have a deep freeze.
I am going to contact the mayor to be sure that he is aware of this.
Hey, Dwayne,
Yes,
before you did your part in the last meeting, you were moving all your papers and buttons around, and it sounded like you were having a wrestling championship in your office.
I was still. I'll try and stay still.
I don't know what it was. Sounded like,
I'm by the road. Cars are underneath me. Maybe that's it.
that's it. Yeah, it's probably it.
But I'll mute. When I quit talking, I'll mute.
Just for the record, I'm
You want us unmuted still?
I'm back. Can everyone see the agenda?
Yes.
Yes. Yes.
Jill. I'm here.
Okay,
guys-
yes.
Did you guys start or?
No, we have not started. We were waiting for you.
All right. Well, I'm glad the court got me out quickly. Again, I apologize to you guys. I had court in Ocala, so I just zoomed to Palatka. We're gonna go ahead and call this meeting to order. This is gonna be the Board of Trustees for Police Officers Retirement Plan, Pension Board meeting. Roll call, please.
Scott Mast, Terrell Hill,
Here.
Greg Cummings,
Here.
Toby Williams. Have a quorum. No one's absent.
Okay, can we just mute all until it's time to speak? We're getting a lot of feedback.
Everyone needs to mute themselves.
Okay. Moving on to item 2 of the agenda, which is our roll call. I'm sorry, which is approval of the minutes. Has everyone had an opportunity to review the minutes that were emailed to us previously? If so, I'll entertain a motion to approve.
Captain Williams makes a motion to approve the minutes from, what meeting was that?
April,
April 21st. So I make a motion to approve the minutes from April 21st.
Okay, there's a motion on the floor. Is there a second?
Okay.
Got a second by Mr. Cummings. Is there any further discussion? Seeing none, all in favor say aye.
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 Opposed, motion carries unanimously. Moving on to the Sawgrass report. Greg, gosh, you're up.
All right, good afternoon. Can everyone hear me?
Yes, we can hear you.
Okay, good. I heard silence. I'm like, okay, you guys got to unmute too. Well, good afternoon. Again, my name is Greg Gosh. I'm Client Service Manager for Sawgrass Asset Management. We manage fixed income for you. First of all, I want to thank you for your business. I know this has been a fearful and hectic time last quarter. Things have bounced back since, which I know Burgess and Dwayne are going to talk about. I also have Learden Gia, who is on your portfolio management team. He's a portfolio manager on the fixed income team who's going to go through your portfolio a little more in depth than what I normally do because he's in there pulling the levers on a daily basis. But again, I want to thank you for your business. We've been working with you 19 years. It's crazy. I was thinking this morning how it's been 20 years since year 2000. And what a fun year to have right now since that period with everything that's going on. It's just been crazy. But if we can turn to page 9 in our book, Jill.
yep. Okay. Do you see page 9?
No, I see the agenda. Does everyone else just see the agenda?
Shoot. Okay, hold on.
There we go.
Okay.
We got it. Okay. So if you look at a year ago, you were just over 2 million with us. Cash flows in of 421,000. Investment gain of a little over, well, if you take out the net cash flows, just under 10% in a year, 2.7 million as it stood at 331. If you'll turn to page 10, Jill.
Mhm.
Thank you. Looking at performance, looking at the 1 year, just under 9.6%, 5 year at 5.3%. Since inception, just under 5%, which is about the long-term average of what you're going to get from fixed income. But what's happened, and Learden's going to talk about this in more detail, is the reason to have fixed income is that bedrock for when things do go crazy in the equities markets and the economy as a whole. When things get hairy out there, people flood back to bonds, back to treasuries, not as much corporates, but the kind of corporates we buy and the treasuries and agencies we buy, we use the term quality a lot. What quality means is the companies we buy into have strong balance sheets, strong businesses. We don't have to worry about them, going under and defaulting. They're companies that are making money, and they're going to be able to pay off their coupons, and they're going to be able to pay off at the end of the bond's duration. So with that, you can see for the quarter, which this was a hairy quarter, you had a lot of fixed income managers that had negative returns. Now you see the index was up positive 3%. We were up positive 4%, but a lot of managers out there that would get out there into the non-investment grade world, that would get out into commodities and other things to try and stretch for yield, which a lot of managers have done over the last really 10 years. Those managers had a real tough time in the first quarter. And I also want to remind you, back in 2008, when we were also working for you, when things were similar to what we've just gone through, in a little bit more stretched out time period, hopefully, than what we've gone through. Hopefully the worst is over, but we can't predict that yet. We'll know in a couple of years if we've gone through it all. When things get ugly, that's when we really prove our mettle, because of the conservative, conscious, risk-conscious approach that we take to things. And we just feel that taking your risk is more apt for the equity markets than it is in the bond markets. Reaching for a little bit of yield and a few basis points isn't worth losing a ton of money that can happen when you do have one of these fall off a cliff moments that we've seen, like we saw this first quarter. So with that, I'm going to hand things off to Leardon and let him talk to you about what happened, how we're positioned moving forward, and why we think that we're just going to keep kicking butt for you.
Thank you, Greg. Well, good afternoon, everyone. I'm Leardon Gita, Fixed Income Portfolio Manager at Sawgrass. First, I'd like to, again, thank you for your business. We appreciate the opportunity to manage your fixed income portfolio. As Greg mentioned, Q1 was really extraordinary. I should say it was historic with regards to the financial markets. We saw some incredible moves in pretty much every asset class. We saw a period where there was a lack of liquidity, even for the treasury market. That is the deepest, the most liquid asset class in the world. Even for that asset class, we saw tremendous volatility. Mortgages for a period of time were struggling, were under severe pressure. Corporate bonds, the credit market was essentially frozen. Commercial paper market was completely shut. So basically, a lot of good companies, they couldn't refinance, they couldn't roll their short-term debt to fund their payroll and fund their operating expenses. So this was a pretty severe crisis unfolding in such a short period of time. We also saw the quickest, the fastest 30% sell-off in stocks in history in the span of just 23 days. So this was a true severe crisis in the financial market. And then we got the Fed step in and intervene and trying to restore the confidence. They launched a whole menu of different programs. They started with an emergency cut. They cut the rates down to 0, and then they restated the quantitative easing program, initially starting with treasuries and mortgages. But then as the crisis was unfolding, they also included the corporate bonds, and then later the high yield bonds and municipal bond securities in that asset purchase program. So all that intervention, coupled with the big stimulus that we got from the fiscal policy with the CARES Act and many other programs that were announced after that, all those actions really helped restore the confidence in the marketplace. And so since then, we saw that V-shaped recovery in not just stocks, but in fixed income and in corporate bonds and high yield and all the riskier sleeves of the fixed income universe. All those assets had a decent return. So essentially, if you were to look at the quarter, you got the two parts. The first part where we saw the crash and everything selling off, and then you had that V-snap. The second part would be the snapback recovery, primarily driven by the Fed actions. So in terms of the performance, as Greg mentioned, for the quarter, we had a pretty strong absolute quarter, 4%, 4.07%, handily outperforming the benchmark by 92 basis points. And that brings the year up 9.6% absolute, outperforming the benchmark by 67. I would categorize these as a very strong absolute numbers, especially in this kind of environment where every other asset class has underperformed. So this is the time where it really pays off to have a high quality manager like Sawgrass focusing on investing in strong companies and treasury securities and government agencies that have very little credit risk and do protect your portfolio in markets like these. So trying to explain the outperformance, I would focus on the three main drivers of the returns. That is the interest rate risk positioning, sector allocation, and the security selection. With regards to the interest rate risk, we had a neutral position relative to the benchmark, so that was pretty much a non-event. The largest driver of our positive excess return was really the sector allocation. So if you turn with me on page 25, so this page talks about the activity for the quarter. I wanted to point out that heading at the beginning of the quarter, we started with a very heavy underweight position in corporate bonds, because at the time they were trading very rich in valuation, and especially when you adjusted for factors like lower quality and longer maturity, the valuations back then were extremely rich, and we thought at the time risk reward wasn't favorable, and we turned very cautious in corporate bonds. So you can see in the top half of that page, the credit risk ratio, that is essentially the corporate bond risk that we have for your portfolio. You can see that at the beginning of the quarter, that number was at 49. So we had a 49% underweight to the index. And then as the risk started selling off, we benefited. And then at the most severe point of the sell-off, right after the Fed started intervening and included the corporate bonds into their asset purchase mix, that's when we started adding the corporate exposure, essentially benefiting on the way back. So that move, that pivot, if you will, it really benefited your portfolio and allowed that decent return, that decent excess return for the quarter. And then finally, with regards to, and then one more thing on this page, on the bottom half, you can see another way of looking at it is through the sector allocation changes. You can see the corporate weights. We started with a 20% position, and we brought that up to 40. So we added 20% in dollars to corporate bonds for your portfolio. The other factor that I wanted to mention was the security selection. So if you switch to page 28, please. So this is a list of the current holdings in your portfolio. And so the common theme here is that they all have a very strong balance sheet, a high fundamental score. This is our proprietary model that we put together to screen for ideas and monitor credit risk. So the common theme here is that we favor and we focus on strong companies, and focusing on high quality, strong companies was a real benefit for this quarter, and that really helped your portfolio as well. Looking at the current positioning on page 32, you can see the current yields on your portfolio at 1.9%. So it has a higher yielding strategy versus the benchmark, with roughly the same interest rate risk. If you look at the sector allocation in the bottom, as I mentioned, we've turned overweight corporate bonds because of the valuations. We're still maintaining the overweight in mortgage-backed securities because of the carry, the extra income that you get from that asset class. And same thing with the agency securities, which are government guaranteed. And then we've turned underweight treasuries here, given the valuations. One more page I wanted to mention on page 36. We did some analysis on our relative performance over the full market cycle, and we broke down that market cycle in different phases. And you can see that we have outperformed in every phase of this full cycle. So for example, in that first phase, If you go back in the 2014 and 15, when the Fed was essentially on hold at zero rate policy, trying to help the economy, we managed to outperform the benchmark in that phase. And then the next phase, the rate hike phase, the quantitative tightening phase, with the Fed starting to hike rates as the economy was starting to get hot, we managed to outperform the benchmark in that period as well. And then you can see the next phase when the Fed went on hold, because the economy started to cool off, we still managed to outperform the benchmark. And then finally, in that last phase, when you see the market crashing, the Fed going to zero and reinstating the quantitative easing and all the other risk assets within fixed income underperforming, we still managed to outperform the benchmark. So this is just another good illustration of our dynamic approach to risk management and providing that consistency of a positive excess return in a very risk-controlled manner. So with that, I will conclude my brief presentation and I'll take any questions.
Do we have any questions? Seeing no questions, I'll entertain a motion to approve the report.
Captain Williams makes a motion to approve.
There's a second.
Greg Cummings, second.
We've got a motion on the floor and a second. Any further discussion? Seeing none, questions called. All in favor say aye. Opposed,
Aye.
motion carries unanimously. Okay, again, I want to thank Sawgrass.
Thank you.
Thank you.
Moving the agenda. Up next is Capital City.
Okay, good afternoon. This is Dwayne Madron, Capital City Trust. We have also been on the account 19 years, and I've been here 15 of those 19. So having said that, I think Jill might be moving towards putting my presentation up and sharing that with you. But obviously, the first quarter of this year was disappointing because, as you know, we've had a recession, which are in the middle of a recession, but it's an event-driven recession, and it came on quick, and it will leave quicker than an economic recession. And so the good news is, by this fall, many economists say that the economy will be clicking along quite well, and next year even better. So since March, things have gotten a lot better, especially because the Federal Reserve stepped in and told everyone that they would do everything in their power to keep the economy moving forward. So what's happened is, because interest rates are pretty much zero, that's pushed money off the sidelines and into stocks, along with the hope for a near-term recovery of vaccine and the fear of missing out. So there's a lot of money chasing growth companies right now. And even today, you can see where the market is way up. So I don't know if, I'll go ahead and talk. I don't know if, while Jill is trying to put the presentation up, but on your policy, you're heavily overweighted large US companies. And these companies have been able to weather the economic storm much better than mid and small cap companies. And this is typical when a recession hits. In fact, the companies that are driving your returns are companies such as Facebook, Amazon, Microsoft, Google, Berkshire Hathaway, Johnson & Johnson, and Procter & Gamble, to name a few. Those are the companies that are driving the tech sector, which makes up about 25% of the stock market. So we're overweight large US companies at the expense of being underweight international, small cap and mid cap, and even real estate, because as you know, when companies have trouble, they also have trouble paying their rent. So real estate has been hurt. So real estate is underweight. Convertible bonds are underweight because they have an equity component, and fixed income has floated up to be about neutral. So I did invest 1% of the fund in March, and I invested 1% of the cash last Thursday after the 5% pullback. And so those two moves have worked out. And as time goes on this summer, I will be putting a lot more of the cash to work. anticipating a recovery this fall. There's no questions. We can scroll on down, Jill, to the performance. So this is what I was talking about. The first quarter performance for the equity side was minus 20.42. Equities were down 23. The bonds, which are the high yield and convertibles, were down 12.2. Real estate down 24. Again, you have an equity portfolio which is geared for up markets, and most markets are up. So in down markets, it doesn't do well, but that has quickly gone away. And as you'll see, as we scroll down, Jill, to the month of April, things have changed quite a bit from minus 20 to minus 12. Equities were minus 23, now they're minus 13, so 10% increase in equities in 1 month. In May, the total return on the equity side has been 5%. June, we're treading water. So things are much, much better, and I anticipate they'll get even better throughout the year because valuations are on many stocks are reasonable. In the tech stocks, they're a little rich, but some of those companies have great promise, like Zoom, for instance, and even Amazon that has its own airport now in some cases. So there are bright spots of the economy, and if you look closely, you can find them. And I think in a minute, Burgess will talk about the fiscal performance, which is even better. So if we can scroll on down, Jill, to the asset allocation. This is as of May 29th. The fund is 10,536,326. You have 58% in equity and 33% in bonds. And that is a moderate growth portfolio. It's not risky, but it's not conservative either. It's somewhere in the middle, which is about where we want to be. Real estate is yielding 4%, and we haven't seen that in a while. Cash is at 517,000, and that is actually lower because I put about 120,000 to work on Thursday. So you're probably at 3% cash, 3.5% cash right now, and that will be going down. So we're working hard. Hasn't been a great first quarter, but I'm optimistic. Any questions? That concludes my comments.
Seeing no questions again. Thank you, Dwayne.
Thank you.
Go ahead and entertain a motion to approve the Capital City report.
Dwayne makes a motion to approve the capital city report.
Second, Cummings.
There's a motion on the floor and a second. All in favor, say aye.
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 Opposed, motion carries unanimously. Moving on to this time, Burgess Chambers.
Hello, Mayor. How you doing?
Great, how are you, sir?
Good, very good. I think Jill just put my report up. What I'd like to do, I'm going to keep this brief, is give you an update of the fiscal year-to-date return through the end of May. Now you can see in my report that the fiscal year-to-date on page 7, the FYTD return through March 31st was minus 11.1%. Minus 9.9%. And if you add in the 13% return that you're able to earn through Cap Cities for April and May, that boosted the return from a negative 9.9 to about a positive 2.3%. We looked at this not last Friday, but 2 Fridays ago, you were up around 5% positive. Then last week was a really rough week. The market was up today strong. I think it's backed off a little bit, but if the market continues to hold on and kind of reprice itself back to where it was about 7 or 8 trading days ago, you could very well see a plus 5% return through the end of June. And something that was mentioned a little while ago by Sawgrass, this downturn, this huge downturn, which was as much as 30% in equities, depending on which one you're picking, which category, in 1 month. It took 1 month for this to happen, where in 2008-9, there was about a 15-month decline in the stock market, which bottomed out coincidentally in March of 2009. This bottoming occurred in March of 2020. It's amazing, really. And now to see this bounce back, and the remarks I heard earlier, I don't want to repeat them, but thanks to the Fed and Congress for working in concert to reestablish liquidity and confidence, that maybe short-term confidence in the market is what's propelled the equity bounce. Any questions so far? Okay. Let me take you, please, to page 11. And just to underscore the severity of the volatility, which you see in the quarter ending March 31st. Remember, this all started in the latter part of February and ended around March 24th. Domestic equities are down 23.1%, and the smaller the capitalization, mid and small cap, for example, the lower, the worse the return. A small cap was down 30%. Now there are two added strategies that were helpful here. The infrastructure, denoted by Cohen & Steers, was down only 17.6% versus the 23 above. And then the convertible bonds are down minus 13.4% versus 23%. I should add that the convertible bonds fiscal year to date are actually positive. They're considered an equity here by statute. It's the only equity category other than large cap growth that has posted a fiscal year to date positive return. The last point I wanted to make was on the next page, page 12, Sawgrass did a really good job for you. They eked out about a 4% return for the quarter, outperforming 90% of their peer group. There's some other bond managers we track, and they were down as much as 1.2, 1.5%. And that's because they own too many credits. They own too many corporate issues. Where I think you picked this up a little while ago, what Sawgrass did going into this downturn is they had an overweight to governments, meaning an underweight to credits or corporates. That's why they got these big returns. And then recently they pivoted back to credits because of the attractive yields, and they are now underweighting U.S. government bonds. So I think the team has performed very well. Dwayne continues to nibble back into equities. The timing is good for that. And that's all I have. Open up to any questions you might want to ask me.
Any questions?
No questions.
Seeing none, I'll entertain a motion to approve the report.
Captain Williams makes a motion to approve Burgess' report.
Greg Cummings, second.
There's a motion on the floor and a second. Is there any further discussion? Seeing none, questions called. All in favor say aye.
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 Motion carries unanimously. Again, thank you again, Burgess.
Thank you, and thank all of you for your service.
Okay, we got Klausner, Kaufman, Jensen, Levin, Harvey up next.
Hello, everybody. How are you?
We are good. How are you?
Doing well, thank you. Let's
see here. The first item is the buyback. I'm sorry, cyber insurance. I sent out an email back about a month ago that went through the different options that were discussed at the last meeting. Did the board have a chance to look at it?
Yeah, can you speak up just a little bit for us?
Sure, is that better? At all?
It's a little better.
Is that any better?
Yes.
Okay, wonderful. So after the last meeting, there were 3 different options that the board was considering, or that at least they had questions about regarding the cyber insurance. One was whether or not they should get a combined policy with the 3 plans. The other question was whether or not they should present to the city commission whether the city should increase their policy by $1 million in order to increase its coverage to an acceptable amount to cover the 3 plans. And then the other one was whether or not the board should get their own policy. So as I mentioned, there was an email that went out. Jill said that she passed it around to all the trustees. And I was just wondering if you had a chance to read it, and if so, if there were any questions.
Are there any questions?
No questions.
No questions.
No questions at this point.
Okay, so what it looked like to me was the best, or the best position for the boards would be to see if the city would increase its policy to cover the 3 pension plans. And as Jill mentioned at the previous meeting, I think that's going to go before commission at the next meeting. Is that right, Jill?
That's what I've been told, yes.
Okay, if that's acceptable to the board, then we can go ahead and wait to see what the city commission will do on that issue, or is there another direction that the board would like to take?
No, I think that's probably the best option. I know Don Holmes is in the room as well. Don Holmes is new city manager. Mr. Holmes, you got any comments?
No, I think that's the best action to take as well.
Okay, then at this point, we can wait until it's addressed by city commission, and we can table it and discuss it at the next meeting.
So at this time, I entertain a motion to table.
Captain Williams makes a motion that we can wait to see what the commission decides on the subject matter of insurance.
All right, it's Captain Williams' extended motion for tabling. Is there a second?
Second.
It's a motion
Cummings.
and a second by Greg Cummings. Any further discussion? Seeing none, all in favor say aye.
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 Opposed, motion carries unanimously. Thank you. Item B.
Yes, so it came to the administrative attention that there was a former member who was a city police officer for approximately 12 years, withdrew his employee contributions when he terminated city employment, I believe back in 2011. This individual has been rehired by the city as a police officer and is seeking to purchase a buyback of the time that he was a city police officer. So approximately 12 years, a purchase of approximately 12 years of time. In your packet, you have a breakdown of the 3 options for that cost to the member. This was done by the actuary Foster & Foster, which will go ahead and explain to you that in more detail. And then I can go ahead and review the city ordinance for you on this issue. Or would you prefer that I review the ordinance first?
Go ahead and review the ordinance first, and then we can go through the options.
Okay, wonderful. So the city ordinance is section 2-250.155. It's the accredited service forfeiture and reinstatement section of your ordinance. Subsection C talks about, subsection C provides forfeited credited service may be reinstated by a member by paying the plan the amount necessary to make the fund whole for the purchase of this service. Repayment shall be initiated and completed within 5 years after the member's reemployment. Payment must be made in one lump sum. So the issue before the board is whether or how much should this individual pay in order to make the fund whole. And that's a decision that the board can make. They have to interpret the statute. What does it mean to make the fund whole? And that's where we stand. The second, Jill and I were talking about, there's another section in your ordinance that talks about the buyback of non-intervening military time. And that section, although it's not the same, it kind of helps to show maybe the city's intent on what they meant by making the fund whole. This section says the purchase, effective January 1, 2008, the purchase cost of each month of military service credited under the provisions of this section is the full cost of the actuarial impact to the member of the purchase and additional years of service plus any fees associated with the calculation of the service. So this section specifically states must pay the full cost of the actuarial impact, whereas this provision that we're concerned with says to make the fund whole for the purchase of this service. Are there any questions?
Yes, ma'am, I do, when it's appropriate.
Sure. Go ahead.
First of all, Jill, do you have that section that was just cited regarding buyback of or credit of military service? Is that something you can put up on the screen? I don't remember seeing that in the emails. Maybe
It's up. It's in there.
It was sent as an email, I think, yesterday because Mr. Cummings had a question. I don't know that I have it as a document to put up right this second. Let me see if I can find.
I'm pulling it up on my emails from yesterday.
Okay.
Sent by whom?
Sent by me. Are you able to see it here?
Oh, you just put it up. I'm sorry. I apologize.
Yeah.
Scroll up.
This is section C that she's talking about. Forfeited, you can see B and C.
No, I'm looking at intervening military service, credited service. That's what I was
Okay, that's right underneath it.
So where's the definition?
I'm sorry. It's the non-intervening military service, not
Okay,
the intervening military service.
okay, that's a part of the ordinance I didn't copy. I just copied this forfeited part of the ordinance. I don't have a copy of that.
But is it in the email you referenced from yesterday?
No, this is the email I sent. This is from
I
the
can-
email I sent.
I
Yeah,
can send you a quick copy if you'd like to see it.
I would.
I'll send it right now. Does anybody else want to see it?
Is there a way you can put it up on the share screen?
if she
don't,
sends it
that's
to me, if you send it
Okay.
to me, Cassandra, I'll be able to get to my emails and put it up.
I'll do it right
Well,
now.
My central question was whether or not there was a commonly accepted definition of make the fund whole, which seems to be the operative question. And if we do have another section of our own ordinance which seems to address the same concept, then I would certainly be interested in looking at what, quote, make the fund whole, close quote, might have meant in that context, even though I understand the same exact language might not have been used.
Yes, I just sent you and Jill that portion of the ordinance. And generally, make the fund whole means actuarial whole.
And to simplify it for me, would actuarially, pardon my, actuarially whole, would that basically be option number 2?
Yes.
That would be, let me see.
Hi, this is Luke from Foster and Foster. Can everyone hear me?
Yes.
Yes, you can go ahead and pick it up, Luke.
Right. So to answer your question, the cost to make the fund whole would be option 2,
Oh, thank you.
the 240,000.
Thank you.
If you take a look on the shared screen, Jill has up the section regarding the non-intervening military service. And I highlighted the section that's applicable.
Thank you very much. I appreciate that.
Absolutely.
I apologize for interrupting, but that answered the questions that I had.
Great. Are there any other questions?
So I guess along those lines, with Mr. Snyder's buyback, will there be a adjustment in his onboarding date for calculation of retirement? So he was on board for 11 plus years. He's going to buy those back. Does that now bump up to go 11 years back from 2016, February 25th, when he came back on? Or does it start when he originally started and comes forth?
So it'll bump up his hire date. So he was most recently hired in 2016. If he purchases the 12 years, it'll be as though his 2016 hire date now becomes 12 years earlier.
So copy that. I guess under the calculation used in B, are we double tapping from February 25th of 2016 forward to put in the full actuarial costs? Because he's, as a member of the police force, he's been contributing and getting the matching contributions from the city and the state since February 25th, 2016, when he was rehired. Are we also including in the amount calculated in option 2, or that is that a double tap? If that's a clear question.
So I think I understand. So we are considering the fact that he has made, he and the city and state have made their contributions since 2016. So there's no double counting there. Does that answer your question?
It does. One more. Had this come before us, say in 2016 or before the board, the calculation would have been up until the point that he pays. So if he waits until February 24th of 21, the day before the 5 years is up, will there be a recalculation of the amount for the lump sum? Over.
Generally, the city ordinance isn't very specific on that issue, but generally, members typically have 6 months from the calculation to purchase the service. So if he waits that long, I would imagine we'd have to update the calculation, and then the amount he has to purchase would increase.
Okay, that clears my question. I was trying to see a case where under option 2, had he made the purchase or request in 2016 and then had the 5 years to pay, would he be paying that amount? But if it needs to be recalculated, then I see.
Any other questions?
So Captain Williams, yeah, if option 2 is the calculation to make it whole, I'm confused, which is not hard to do. Why is there option 1 and option 3?
You're breaking up, Captain.
So if option two, can everybody hear me okay?
Okay, now, yes.
If option two is the calculation to make it whole, what's the option 1 and 3 then for? Would they also
So
make it
option
whole?
one, I'm sorry?
Would those two
So
make,
option,
would
let me just quickly go over option 1 and 3. So option 1 is he's basically repaying his contributions that he withdrew in 2011 with interest. So that doesn't account for the city and state contributions that were made. Option 3 is pretty similar to option 1. It's the cost under option 2, accounting for the fact that the city and state made contributions during his first period of service. Does that make sense?
I think so, yes.
So there was maybe a clarification of the increase amount that will be that will occur for option 1 or 3 to the city and the state match to then make it whole or I guess equitable for other employees. Please correct my wording if I misspeak. So if we pick option 1 or 3, it sounds like for the 2020-2021 fiscal year, we're looking at an increased contribution of 1.1%.
That's correct.
Ask another way, with the buyback of the 12 years bumped up against the rehiring time, would a person with no break-in service from that date until the period, will they be then considered equal?
So comparing him to someone who was hired in 1999 and worked continuously through today?
Or the adjusted period for the 5-year taken out, so 2004 until now.
I see. So his adjusted hire date would be around 2004. So if someone was hired in 2004, based on their service, they would, yes, be equal. There'd be differences in their benefit and liability due to their salary, since the benefit is salary-based. But with regard to their credited service, yes, they would be equal.
Okay. I guess option 2 just bothers me a little because now we're asking an individual to pay the corresponding city and state portion, where when he took his funds out, the city and state matching piece actually stayed in the fund and continued on growing and or losing, depending on that particular year or rate of return with the fund. So option 2, I'm very concerned about that mass amount theoretically to make the fund whole. So I'm more inclined to option 3.
Could I have an opportunity to speak?
Yes, sir.
So my concern is with options 1 and 3, and it's as follows. If I understand it correctly, and I don't profess to be an actuarial, nor do I profess to be a fund manager or an expert in this field, but if I understand it correctly, while the city money remained in, the funds that had been contributed by the city towards Mr. Snyder's retirement during the 12 years of his earlier employment remained in the fund, and he took all of his out. the money that the city contributed in the fund, which was left in the fund, was then used in those years since Mr. Snyder withdrew his funds in the calculations that determined how much the city had to contribute, how much the employees had to contribute in order to fully fund the retirements. Is that correct?
Yes, that's correct. So that, as you mentioned, the city and state contributions that were made during his first period of employment, those stayed in the fund and were used to fund then everybody else's benefits. So there was an actuarial gain back in 2011 when he terminated employment.
But now if he comes back in and he only pays the amount that he withdrew and the interest, then basically the city has to go back from its budget and make up for the funds that were kept in the city's contributions towards Snyder's first 12 years, as well as everything they made since he withdrew his funds. Is that right?
Right. There is, I guess. Right. It sounds like you're asking if the city's funding requirements are going to need to increase, which, yes, they would. But like I said, there was an actuarial gain in 2011 when he terminated, and then it's sort of like offsetting the gain in 2011, if that makes sense.
Well, I think it's very confusing to me, and then I have to fall back on the language of the ordinance and the issue of consistency. So I guess that's the troubling portion for me. If we're going to interpret this in a way that indicates the employee only has to pay back what they withdrew plus interest, and that's going to be the policy, then it appears we've got an inconsistency between the military buyback or the military credited service and the employee buyback. And it also appears that the city would have to, I mean, would that not mean the city would be essentially, I guess you'd say, vulnerable to always having to recalculate the amount of money it had to put back in to make up for someone who came back and wanted to buy their old service? Did you understand my question?
Are you asking if this happens for anyone else in the future, would there be a precedent set?
Well, I guess I asked two questions, and that's the problem with asking two questions. First question was, if we interpret the language in the section that was cited, make the fund whole. If we're interpreting that to mean that making the fund whole only means that he has to pay back the amount that he withdrew plus interest, then that's a precedent we're going to have to continue to apply unless we change the ordinance. Would you agree?
Yes, that would make sense. Yes.
And that conflicts, as I understand it, with the other section that was just put on the screen when it comes to buying back military credited service. Don't you agree?
A question on that one, Mr. Holmes. So there was an intervening military and a non-intervening military. And please correct me if I'm off. If the non-intervening piece was, let's say I came out of high school, went into the military for 4 years, got out, got on the police force, and I wanted to apply that non-intervening service of 4 years. Is that what the non-intervening is talking to? Because theoretically, if I'm in the Guard and I was a policeman already, and I went on active duty for upwards of 5 years, you would continue to match my city and state amount, as well as put me in as if I was still there when I got back after active duty to go. So I think there's a delta between intervening and non-intervening, but correct me if I'm misunderstanding that, because you're right. This is a difficult one. Is this the first, or is this? Do we have any previous examples of reinstatement? Over.
I'm not aware of that. I don't know.
So we did do some research. There was one other person back in 2008 who was in a similar situation, but not the exact same situation. He was making the purchase immediately after being rehired, whereas Mr. Snyder's been rehired for more than 4 years now. So back in 2008, that individual, I believe, paid their member contributions with interest.
If I may, this is Cassandra. I'm trying to find that email because I remember reviewing it, the one with the buyback from 2008, and there was a distinguishing factor there where the board was using the statutory language and not the language of the plan. That was one of the differences there. And I think, Luke, you can correct me if I'm wrong, I think in that situation, he paid back, was it the employee contributions, or he paid back a lesser amount because the board interpreted the statutory language, not the provisions of the plan.
Right, he paid his member contributions he withdrew with interest, not the full actuarial cost.
Do you have that email you can send me, Luke, so I can, or if you can read and just explain to the board what the difference was in the language of the statute compared to the language of the ordinance?
Sure. So let me give me 1 second here. So I'll just read the exact language. It says, a police officer may not receive credit for the years or fractional parts of years of service if he or she has withdrawn his or her contributions to the fund for those years or fractional parts of years of service, unless the police officer repays into the fund the amount he or she has withdrawn, plus interest as determined by the board. And they have at least 90 days after his or her reemployment to make that repayment.
And that's a state
Thank
statute?
you. Correct.
That's
That
the
was
statutory,
state
yeah.
statute.
And that differs from the language that we have in our ordinance.
Correct.
In the earlier case, the board applied the statute instead of the ordinance. Correct?
I'm sorry, can you repeat that?
In the earlier case that you're citing, the board at that time applied the statute's language rather than the ordinance language.
Right.
Well, can you tell me if there's and this may be going beyond the scope, but I'm genuinely searching because it is confusing to me. Can you tell me if there's any sort of principle regarding the state statute being preemptive over a conflicting ordinance regarding a retirement plan, or vice versa? Is there established principle that the wording of a retirement plan preempts contrary state statute?
No, this is Cassandra. I conferred with Bonnie on this issue. She's one of the partners of the fund, of the firm. And she said that you go with your ordinance, and the board is tasked with interpreting the wording of the ordinance. I'm not sure why the state statute was used in 2008. I don't know why.
Because the state statute was clear and unambiguous to me. It specifically stated he repays what he withdrew plus interest, or he or she, the officer, repays what they withdrew plus interest. That's, to me, pretty clear. But that's obviously not what our ordinance says.
That's right. So the board has to decide what their ordinance means. And then if in the future you want to go ahead and clarify that ordinance, or make a policy, as I think the city manager had mentioned. So if this does come up in the future, there's a clear understanding of what the board is going to do.
I apologize for, and I don't mean to dominate, I'm just trying to understand the budgetary impacts too. So I have the email that indicates that if the city vote, or if the board voted for option 1 or 3, the city's portion of what it contributes to the fund would go up about 1.1%. Can somebody quantify that for me in dollars? 1.1%.
That's 1.1% of payroll. Depending on what the actual payroll is, it's probably around an increase of $17,000.
1.1% of
the
whose
year.
payroll? Of the total police department payroll?
Yes, the entire city of Palatka Police Fund payroll.
And that increase would be it would be an annual increase. In other words, that 17,000 would be each year from this point until this employee retires, or each year basically forevermore?
I guess that loss will be amortized over 20 years, so that'll be a 20-year payment.
So roughly 17,000, you think, per year for 20 years, the city would have to pay extra.
Right.
If options 1 or 3 are chosen.
Correct.
Okay. I'm sorry again, I don't mean to dominate your conversation.
That's good. If you have any questions, please ask, because this is the time to flesh everything out.
What's your recommendation?
Well, based on the language of the ordinance, it does say make the plan whole. Forgive me, I'm trying to pull it back up. The ordinance for buyback of credited service to make the fund whole for the purchase of this service. Whole generally means actuarially whole, and then that in combination with the non-intervening military service, which does specifically indicate the section military service under provisions of the section is the full cost of the actuarial impact of the member. To me, says that the city intended for the whole cost, the actuarial cost, to be repaid.
Any questions? Thoughts, comments, motions?
Yeah, Greg, I guess this as I looked at the numbers for option 2, it seems to treat the payback of going from 2011 all the way through second quarter of 2020 as if he was not rehired per se, but is asked to pay back everything that the plan would have made, including the city and state contributions, to get it back, and does not actually consider that he was rehired in 2016 and the state is already matching some of the contributions. So the focus of the payback would seems to be for me from 2011 to 2016, but I think the way Foster has described it, I'm incorrect on that, but in my gut, something doesn't seem right if we're asking north of 200,000 to be paid back to get those 12 years over.
Anyone else?
All right, so it's Captain Williams. So option 3 pretty much matches with the state statute saying that an individual would have to pay back what they took out plus interest for that time. So I can understand that. That's pretty clear and cut. So in this case, it sounds like option 2 is everything which would have been there if he would have stayed. Does that make sense? Is that right?
Can you repeat that?
No problem. Yeah. So option 3 is pretty much, to me, seems clear. And that's based off the state statute saying that the individual would pay back what they took out plus interest. I can understand that. But option 2, that figure is based off if he would have never left and stayed, if his money was there, the contributions were being matched, and interest, all that, that's that total number. Is that right?
Just real quick, it would actually be option 1. Option 1 and option 3 are very similar in amounts, but option 1 would be the closest to the statutory language, which would be him repaying his the contributions he withdrew plus interest.
Okay.
And then option 2 is essentially he's paying the amount that would result in no additional contributions for the city and state, which does not take into account the city and state contributions that were made previously. Does that answer your question?
Yes, sir.
Okay. Any other questions at this point?
I do have one other question. Sorry, guys. So do we have any idea why back in 2008 that, and this may have been answered or I wasn't paying attention, why the board went with the state statute?
This is Cassandra. I don't know why the state statute was used in 2008. Luke, do you know?
I am looking back at the calculation. Our records weren't the most detailed back then, but I'm looking at a handwritten note that says, per Trish, that may be Patricia Shoemaker from the Division of Retirement, that if he pays back within 90 days, he can just repay his refunded contributions with interest. So that may have been a decision that was made by the Florida Division of Retirement. I'm not positive though. So
I guess the question is, have we created a legal precedent based upon what we did back in 2008? And I guess we'll leave that question for council more than anybody else, because I kind of know what my answer is as to what the prior interpretation did.
So I think the difference between the 2008 calculation was that he repaid his contributions with interest within 90 days of his reemployment. So I think that would just be the difference in these two cases.
As opposed to Mr. Snyder, who's been reemployed for almost 5 years now. Is that correct?
Right.
Okay.
So if that was the case, we're saying that the 5 years would, in essence, take him up another 6 figures, about 150,000 additional dollars, I guess 180,000, based upon what we're looking at, the difference of the numbers.
I'm not sure I understand.
So the calculation under the options the numbers are significantly lower. And so we're saying that by him being employed for the additional 5 years, that his contribution is going to be that drastically different.
So you're comparing option 1 and 3 to option 2?
Correct.
I guess I'm not, I guess I still don't really understand your question, but option 2 isn't really considering the fact that he, like, if he still worked those 5 years he was out, it's pushing back his 2016 hire date 12 years earlier to 2004. I'm not sure if that clarifies anything.
No, it doesn't really.
I have another.
I guess I guess I kind of have the same concern that Mr. Cummins had earlier as to whether we're actually double dipping and or hitting him twice. So,
So if I
Go ahead.
may, Lou, can you just break down option 3 for the board? So option 3 is a little bit or a little more than option 1. And if I understand the email you sent to Jill correctly, that option takes into consideration the city and state contributions that were put into the plan on Mr. Snyder's behalf.
Right. So option 2 is the cost, so that there's no additional cost to the city. But that doesn't take into account that, well, during his first 12 years of employment, the city and state had made contributions that were left in the fund. So option 3 accounts for the fact that the city and state made contributions during his first employment. So essentially we're subtracting that out from the cost under option 2.
Okay, and if my math is correct, and sometimes it's not, if he is asked to pay, around $66,000, and we take that number minus the $240,000, that means that the city and state contributed on his behalf for those 12 years approximately $173,000. Is that correct?
Yes, but that's the $173,000 is the amount the city and state contributed with interest through today. So yes, but with interest.
Okay. I don't know if that helps the board or if it makes it more confusing or not, but I just wanted to break that down a little bit more.
So I don't want to belabor this point because I'll admit to you, I'm majored in finance and I'm having problems following the equity of this. And on either side, from either side, I mean, if option 1 or 3 is selected, then as I understand it, the city's going to end up paying an additional $340,000 over the next 20 years, which even reducing it to present values, what, $250,000 or so that we're going to pay, the city's going to pay. If option 2 selected, then Mr. Snyder pays a boatload of money. So my question is this, and I'm probably not going to artfully state it the first time because sometimes questions like this I have to think about a while, and then I may still not artfully state it. But since the state and city money that was contributed on behalf of Mr. Snyder was left in when he withdrew his, did it essentially result in a reduction of the amount that the remaining employees participating in the retirement system had to pay in order to fund their retirement?
Well, the members make a fixed contribution percent, but when he terminated in 2011, that I guess lowered the city and state contributions.
But not that of the employees.
No, because they make I believe it's a 6% member contribution rate. So the employees weren't affected by this.
So a defined contribution amount.
So if I understand you correctly, then the city got a break from the time Snyder withdrew his contributions because they had basically, for lack of a better term, they'd overpaid with regard to funding the retirement of those employees that remained in the system. But the employees who were in the system, they didn't get any particular break. They still had to make a defined contribution to the plan.
That's correct.
So now if the city has to pay more, I'm not trying to argue against myself, but if the city has to pay more now, basically they're just essentially catching up with what they didn't pay before.
Right, that's a good way to look at it. It's the fact that they might have to pay more now is sort of offsetting the break they got in 2011.
Well, I'm not saying it's a good way to look at it from my perspective, because the city's pocket's what I'm concerned about. But I think I want to make sure I understand it, and it is what it is. And I don't think I'm a voting member anyway, so I'll shut up now.
So,
but all good conversation. Whatever we do today, that this will be the precedent, at least for a while we're members of the board.
correct. Agreed. And so I think I think for me, the last comments probably were the most convincing as to the questions that we had, that it's, you know, that there's been a benefit to both sides in this equation, far different from what I'm seeing, far different than what option 2 gives us, which creates, I think, in essence, a windfall for the city. You know, maybe, I guess I'm kind of like Mr. Holmes in this situation. Fairly crazy to say it, but right is right. And I think at the end of the day, for me, I think that option 2, my opinion is that option 2 is overly burdensome to the employee, and it creates, I think, an overreaching benefit to the city as a whole.
Mr. Mayor, for what it's worth, I don't disagree with that assessment. Although Logan may shoot me, so don't repeat what I just said.
It's recorded.
I take it back then.
So I see you, Captain Williams, chomping at the bits. Go ahead.
Oh, you good? I completely agree with you both. Also, I'm kind of stuck in between, because if one says to make it whole, you would think that this would have been an easy decision. There wouldn't have been all these options to look at. That's just what I think. But I agree with you.
I think the big issue is it indicates to us that there's a necessity to make all these different terms as it relates to military service, as well as to the return to service. All that stuff we've got to get rid of the conflicting terminology, or at least create some catalog of terminology which gives us interpretation so that it's consistent throughout all 3 scenarios. And so that in itself, I think, lends to you know, the reality of having council come back and look at that and give us something. But as far as where we are today, do we need any more information, or does anyone feel comfortable making any decision? I've seen, I guess, Matt, you've been quiet on here. You got anything for us today?
Yes, sir. Well, I mean, I was sitting there listening to the $17,000 hit a year, and that just kind of made me go, ooh, but I'm in agreement. $240,000 is a lot to ask from somebody, especially with the precedent we set in 2008. My opinion, just from when this first came out, that I was looking at option number 3 as possibly being one of the best bets.
Thank you, sir. Any other questions, concerns, or we'll entertain a motion at this time?
Greg Cummings here. I make a motion that option 3 be voted upon on behalf of Mr. Snyder for repayment of contributions in one lump sum to make himself whole and buy back his 12 years.
This is Captain Williams. I second that motion.
There's a motion on the floor in a second. I guess, Mr. Cummings, based upon the information that we receive, would there be a time certain for which he has to buy that time back?
So I think the calculation should be calculated each quarter until the lump sum is done. He has until I think the 25th of February of 2021. That's the anniversary or the 5th anniversary of his reinstatement.
Okay. So you've heard the motion and the second. Is there any further discussion on the motion? Seeing none, all in favor say aye.
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 Aye. Opposed? Motion carries unanimously. Again, thank you guys for all your work on this. And also, this dialogue has been, I think, extremely beneficial to us moving forward. I think if the board is okay with the actions that we just took, do we need to give direction to council to review this, or is that something that we can just go ahead and have you do and move forward from there? Do you need an actual motion, council, on this?
To review the ordinance
To
or
review the-
something different?
To review the ordinance and the ambiguities between the ordinance, with the ordinance on the three scenarios we just went over as it relates to military, the intervening military, as well as the non-intervening military.
So if the board would like, I can start working on a restatement of your ordinance. It's long overdue, in my opinion. I would go through the entire plan document and update everything as needed.
Okay, I think that will be definitely the best option for us at this point. And I'm pretty sure there's going to be a mirror in every other pension plan as well. And so,
Yeah.
And so I think that will at least place us all on firm footing. So definitely.
Okay, if that's what the board would like, a motion would be in order.
I'll entertain a motion as such. Do we have a motion directing council to move forward?
This is Captain Williams, and I would like to present a motion as such to move forward to review the ordinance and as such to talk about all the differences within that ordinance.
And the plan as well, correct?
Yes, sir.
Okay. There's a motion on the floor to review the plan and ordinance. Is there a second?
Second.
Okay. Motion on the floor in a second. Any further discussion? Questions called. All in favor say aye.
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 Opposed, motion carries unanimously. Thank you very much. Thank you both for the work that you did on this, and we definitely appreciate it. And also thank you to everybody for your feedback and comments. I think this has probably been a pretty strong discussion for us today. Moving on to budget fiscal year 2020, 2021. Ms. Kaiser?
Yes, I've just put up the budget on the screen for fiscal year 2020-21. It shows a summary of investment costs versus administrative costs. The costs still include a schooling for 3 trustees to go to 1 conference. That's just how I figured the amount. It might be two trustees going to 2 different conferences, and that's a variable amount. The other fees are mostly pretty based on the prior year. I did include the attorney fees at $6,000, assuming that we're going to continue $6,000 per calendar year, as we did vote on last meeting. If this is acceptable, then we'll need a motion.
Questions on the budget as presented?
Scott Williams like to accept the motion to accept the budget as presented.
Second.
There's a second on the floor by Mr. Cummings. Is there any further discussion? Seeing none, all in favor say aye.
Aye.
Opposed, motion carries unanimously. Thank you. This is the simplest budget I've had to pass all year. Appreciate it. moving forward with our expenditures.
Again, this is just 6 months of expenditures for the pension. And the individual breakouts of Sawgrass, Capital City, administrative expenses, et cetera.
Okay. Any questions on expenditures or a motion to approve?
No questions. Ms. Captain Williams, I make a motion to approve the expenditures as presented.
I second.
Motion on the floor in a second. All in favor say aye.
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 Opposed, motion carries unanimously. Thank you. And when's our next meeting?
Our next meeting is September 17th. But there is one more concern I have, which is we have a vacant. Yeah.
I got you. Let me get a couple. I'll do public comments right quick.
Sure.
Is there anyone here for public comment?
I can check. Let me check the YouTube live for 1 second. There is no public comment.
Seeing no one for public comment, we'll close public comment at this time. We'll move forward to our next item, which is the concern that the resignation of Mr. Clayton. We have a board vacancy at this time. And that has to be someone with, is that someone with the finance background? Is there a particular skill that goes along with Mr. Clayton's?
No.
Okay. And so we've got one board vacancy that we need to fill. So if anyone has any recommendations to bring forward at our next meeting, please bring those forward. I think we've had a time keeping this board filled up since we had our resignations a couple years ago of both Myers. So we look forward to filling that vacancy so that we can move forward. It's good to have you on here, Officer Mass. That helps us out, and so we definitely appreciate it.
Yeah, apologize for being late.
Hey, no need. I was late too, so we're in the same boat. But we're glad you're here. Yes, ma'am.
Sorry, if I may, do we know if the position or the board seat was one of the individuals that is a legal resident? Because your board has 2 legal residents of the city of Palatka, shall be selected by and to serve at the pleasure of the city commission, 2 police officer members, and then 1 individual chosen by a majority of the previous 4 members.
Right now, we got 3 legal residents on here just on this call.
Okay.
Then so.
And we have 2 police officer members on the board.
Yes.
Yes. I think
2
this
police
is
officers. So then an individual chosen by a majority of the previous 4 members
Okay.
is the remaining seat, sounds like.
Okay. So we'll try to move forward with that and try to get that position taken care of. And I definitely appreciate you giving us the standards for member selection.
Absolutely. I do have 2 other things that I wanted to just quickly bring up when you're ready.
Ms. Kaiser, you have anything else?
No, thank you.
Okay, Counselor, you have it.
Yes. The first thing is I would like to go ahead and draft a letter to Mr. Schneider regarding his buyback and the board's decision. Just letting him know, hey, the board met today. They decided that option 3, I believe it was, for the 66,000 is the option that that is what he has to pay back if he decides he wants to pay for the 12 years of service. And just letting him know if he has any, if he wants to appeal, and he has a certain amount of days just kind of giving them a heads up so that way we can put it to rest.
No problem. We anticipate you doing that anyway as a part of the
Okay.
decision-making process to give him the final decision of the board.
Okay, great. And then the second is just a reminder about the annual Form 1 filings, the financial disclosures that is due July 1st. It must be filed with the supervisor of elections office in the county in which you live. And starting September 1, if you haven't filed it yet, then you are subject to a $25 a day fine up to $1,500. If you need any help with that, please let either myself or the administrator know. We can help you out.
Okay.
That's all I have for you today. Thank
you
you.
very much. Is there anything else
Yeah.
before the board today? Seeing nothing else, I entertain a motion to adjourn.
This is Captain Williams. I make a motion to adjourn.
Master, you gonna make the second?
I'll make the second to adjourn.
All right. All in favor, say aye.
Aye.
We are adjourned and we'll be leaving the meeting. The time is roughly 3 o'clock, 3:06. And you guys, thank you all for your participation today, and we'll see you next quarter.
Thank you, everybody.
Thank you.